Good morning, everybody. It's Tuesday morning at 9 a.m. Welcome back to this week's edition of the Merkle Market Update. I'm Loren Merkle of Merkle Retirement Planning, and with us today we have a special guest, Jace Merkle. Jace is my daughter. How old are you, Jace?
8.
What grade are you in?
Second
grade. If you were watching last week's edition, there was a quite the debacle as I was trying to flip the pages. So in order to avoid that, we brought a trusty little assistant, and you're gonna help me flip the pages today, right, Jace?
Yep.
Okay. Jace has been in here every so often since you don't have school anymore. What's your favorite part about the quarantine?
Riding bikes with my mom and playing games with my dad.
Okay. And learning about amortization schedules. Jason's going to help us talk about amortization schedules today. So today's topic, and really the whole point about these Facebook Lives, we do them every Tuesday morning at 9 a.m., is information is everywhere. So we can go online, we can turn on the news, we find information everywhere. Our goal is to provide you information that you can use, meaningful information you can use to impact your retirement plan in a meaningful way. So today's topic is amortization schedules and refinancing. Should you refinance your mortgage? When does it make sense? When may it not make sense? And we're going to get into how amortization schedules work and some of the numbers so you can see what refinancing a house, what refinancing your mortgage might do to your long-term and short-term picture when it comes to looking at amortization schedules. So Jason, you going to kick us off?
Yes.
What do you want to talk about amortization schedules?
Nothing.
Okay, here we go. So we have, what we're looking at here is this is a 30-year mortgage. And we have a 4% interest rate on this 30-year mortgage. Now, the principal payment, so we start this mortgage June of this year. Our principal payment is $432 a month. Our interest payment is $1,000 a month. So we have a mortgage payment of $1,432 a month. And you can see how heavily slanted the interest payments are. So in a mortgage, the amortization schedule is very front-loaded as it relates to interest payments. So the majority of our payments are going to interest. If we fast forward just 10 years into our amortization schedule, now it's June of 2030, 10 years later, you can see our principal payment has increased and our interest payment has decreased. So now it's much closer proportion from principal payment to interest payment. But you can see we're still paying every single monthly payment that we make. More of our payment is going to interest as it is to principal. And that crossover point in this amortization schedule actually doesn't take place until 2033. So 13 years into this 30-year mortgage paying only a 4% interest rate, that's when we finally, every single month, we're paying a little bit more towards the principal of our house, of our mortgage, than we are on the interest. If we fast forward to the full 30 years, then we have a total interest payment of $215,000. So up to the 10-year time frame, we pay, so from 2020 to 2030, we're paying $109,000 of interest alone. But if we stay on this schedule, we will pay $215,000 of interest over that 30-year time frame. Now this is a $300,000 house, which means our total investment in purchasing this $300,000 house is $515,000. That's our true cost. That's a lot of money, isn't it? So what if, with interest rates coming down, the Fed has been slashing interest rates this year, they're near zero. The 10 and 30-year treasuries are at all-time record lows. So we've been hearing a lot about, should we refinance? And I think that this, people have been sitting at home because we can't go to work. People have been sitting at home, they've been researching, they've been watching the news, they've been hearing about this. So this is an extremely prevalent question. Do we refinance? See if you can do a little bit better than I did last week. together we tackle it. Okay, so this is saying we're 10 years into our 30-year mortgage. So this is June of 2030. There's $235,000 of our $300,000 balance that's remaining. So we're going to refinance the $235,000. We are not going to add any additional amounts into this refinance. So we're only refinancing the remaining balance. When we start, and we're going to be able to refinance it at a 3% loan. We're going to use the same term. So we're not shortening the length of the term. Now we're 10 years in. We have 20 years left if we stay on our current mortgage, but we're going to go 30-year mortgage, 3%, 10 years in. So our principal payment is $403 a month. Our interest payment is $587 a month on the $235,000 balance. Over the life of that 30-year loan at 3%, our interest payments will be $121,000. So notice we paid $109,000 of interest the first 10 years at 4%. Over the next 30 years at 3%, it's going to be $121,000, which means we would pay a total of $230,000 if we refinance 10 years in using these numbers. Now remember, if we were just to stay on the original schedule of the 4% loan and pay it all the way through that 30-year time frame, our total interest payments would have been $215,000. Refinancing 10 years into it, amortizing it over a 30-year time frame, we're paying $230,000, which is $15,000 more than what we would have paid over the life of the original loan. So in this sense, from a total interest cost standpoint, did it make sense to refinance? We paid $15,000 extra to refinance, and that doesn't include any of the refinancing true cost, right? The closing costs, the appraisal cost to get the refinance, that doesn't include any of that. That's just from a straight interest cost payment. Now, one of the things you'll notice is our principal and our interest payment, our monthly payment, is significantly less. We're only paying about $1,000 a month when we did refinance. So especially in today's terms, when cash flow might be a little bit tight for everybody, this might make sense, and the extra cost at the end of the amortization schedule might make it worth it, because we shaved off about $400 a month from our monthly expense. So there is that consideration to look at also. But from a true cost, we ended up paying $15,000 extra when we refinanced 10 years into the loan. Now, one of the things we hear all the time is, what if I make an extra payment every year over the course of my loan? How would that impact my true cost of having that mortgage? So what we did is we said, what if, same thing, $300,000, 4% loan, what if we didn't refinance, we just paid an extra payment every single year? So we're not talking about an extra principal payment, we're talking about an extra $1,400 mortgage payment. Then the loan would be paid off in about 25 years, and the total interest cost would be about $181,000. So let's back up a little bit. If we make one extra payment per year, and we said June of every year we're going to make that $1,400 payment, over the course of the life of that mortgage, 25 years, our total interest rate cost is going to be $181,000. Compared to these other two scenarios. The first one, we just said 4% all the way out. 30 years, we paid $215,000. The second one, because interest rates decreased 10 years into the loan, we said, let's take a full percentage off of our mortgage. We refinance, and then we end up paying $230,000 over the course of that loan. So one of the most effective ways to really decrease the amount of cost for your mortgage is just to make an extra payment every single year if you can. You're going to pay it off in five years quicker, and you're going to have $180,000 interest expense as opposed to either $215,000 or $230,000. Now everybody's situation is different. Okay, so these are these numbers. Maybe you can shave 1.5 points off of your interest rate. right? I mean, what we have to do is we have to run the numbers. We have to look at the numbers. One of the calculators that you may find useful, one of the best ones or easiest ones I've found out there is through bankrate.com. It can help you look at the amortization schedule and say, what if? Here's my current situation. What if I do this? And then you can amortize it all the way out and see what the true cost of that loan is for you. So just some ideas, some things to consider. It's not as easy as saying I'm at 4%, I can get 3%, let's do this. Now I can tell you these numbers would look completely different. If in the refinancing calculation, if we would use the same term, so instead of 10 years into the loan, we refinanced it for a full another 30 years, we refinanced it for only 20 years, then it would have been significantly better from a number standpoint. So if you're looking at refinancing to decrease your overall interest cost over the course of your mortgage, maybe consider just using the same term. You know, if you're 8 years into it, maybe just refinance it for 20 years. If you're 15 years into it, refinance it for only a 15-year period as opposed to 30. All of those things are worthwhile to consider. So everybody's situation is unique. Everything is a little bit different. You need to evaluate it and make it a part of your overall plan. And then that way, once you see the numbers, it's going to become much more clear to you which is the best course of action for you to take. What we're going to provide to you as a part of this Facebook Live, as always, is if you would like to reach out to me, on your screen there, you can sign up for a 15-minute retirement checkup call. That's a complimentary 15-minute retirement checkup phone call direct to me. You have direct access to my calendar. All you have to do is schedule a time that works well for you and me. We can have conversations like this about amortization schedules, retirement income planning, legacy planning, anything that might help improve what you're trying to accomplish to achieve your overall retirement vision. Chase, are you going to be a part of those calls?
Maybe.
Okay, we can do that. You've been a good help. Thanks for helping out today. Look forward to seeing you next week on another edition of the Merkle Market Update. Have a great week.